In this video, I'm going to be re-elaborating on the previous video, which I've made in the course sections. It's about basically having aggressive versus conservative TPs. But in this video, I'm going to add a bit more onto that now that I've taught you guys, or you should have seen the IFG scalping strategy. If you have not seen that video, then you might not fully understand what I'm about to talk about in today's video. But basically, it's going to be adding onto the conservative and aggressive TPs. Discussion in terms of concepts. So you guys know that in that past video, I believe I talked about having conservative TPs, which is any TPs within the range, right? So you're going to be flips, origins, inducement. But we do have a lot on today's agenda for this video, but I'm going to try to condense everything quickly. We're going to be talking about a few more forms of TPs in terms of conservative and aggressive and how you guys want to have that in your system. We'll also be going over a few trade recaps I took on Euro USD futures. And then last but not least, we will go over futures versus Forex market in terms of manipulation differences. So that'll be very cool and interesting. I highly recommend you guys to watch till the end if you do trade, especially Forex. Like if you especially trade Forex, you definitely want to watch till the end of this video so you'll understand everything I'm about to say in terms of the manipulation that does occur. But going back to the topic today, conservative versus aggressive TPs. In the previous video, it was something roughly like this, right? External liquidity, which is your external highs or lows, swing highs or lows. You have conservative TPs and you have aggressive TPs. Now we do have two other forms of types of TPs. And if you've seen the video talking about fake reactions already and manipulation legs, you understand what I am essentially talking about here. But essentially, above conservative TPs, we have very conservative TPs. And this is going to be your nearest internal high or low. And when I'm talking about internal, I'm talking about internal structure, of course. And then there's also conservative, aggressive, and then more very aggressive. That's the word. Which would be past external liquidity at another high or low or POI, right? So let's first go over a very conservative TPs. Now for me, this very conservative TPs, I'm not using for my main strategy setup where we're looking for internal reversals in the market, like trades like these. I'm not looking at TP at the nearest internal high or low like this. I'm just bringing this up so you guys understand that when we're trading the scalping strategy, the IFG scalping strategy, we are using very conservative TPs for that strategy. We're literally exiting a trade at the manipulation move. So taking out that internal high or low. Taking out internal high or low. We're TPing for in this long here, we're TPing here. For in this long here, we're TPing. I'll explain this later in a bit, what happened here basically. But you would be TPing here, for example. And then that would be very conservative TPs, of course, if you're shorting, right? Vice versa, right? You would be TPing at the nearest internal lows. So that's very conservative TP, but again, this does not apply to the main setup. Now I'm going to be going over very aggressive TPs. So you guys know for aggressive TPs, we're just targeting external swing structures. So for example, let's say you took a long randomly. Okay, I'm just gonna place a tool here so you guys understand what I'm trying to say here. Let's say you took a long. This would be targeting external liquidity. This would be considered very aggressive. Now, what I consider this would be considered just aggressive. Now, what I consider very aggressive is having TPs past this high or low. So, for example, this is considered very aggressive. Instead of TPing at this high, I'm TPing past the highs plus more. So I'm looking for either a POI that did not get mitigated yet that I'm anticipating my drawn liquidity to be. In this case, it would be this. This is the nearest potential valid POI that's closest to the external here. Or you're looking for just highs or lows past the external already. So maybe you're looking for this high to get ran. Or you're looking for this high to get ran, right? You'd be then extend your TP up here. This would be considered very aggressive TPs. Now, of course, you can see very aggressive TPs tend to hit a lot less, and it's a lot harder for price to go the further away your TPs are. So that's something you definitely want to keep in mind. But that's basically breaking down very conservative TPs, which is, again, only use my scalping strategy, and mechanically defining basically very aggressive TPs, so you guys understand how I sometimes will take trades. Like, for example, this is I'll go over this trade real quick, and I actually did not get stopped out here because I took my trades on Euro futures, not Euro USD, or the Forex broker here. The Forex broker here is CMC Markets. I just found it to have the cleanest charts, that's it. So I just use it for charting purposes. But here is a good example of a long. Pretend I didn't get stopped out here. Just ignore this price here. You'll see later what I mean. But basically, this is an example of a very aggressive TP. I'm TPing past the external, which is my aggressive point. I'm looking for a POI that's closest to that external that price could potentially go towards, or even further, right? If I'm looking, maybe looking at these highs. Now that'd be, to me, way too aggressive, because right here we have a 5-minute supply. We also have 15 minutes aligned right here, and price was in a downtrend, right? So I TP'd just at that internal right here, or that POI right here. So this is considered a long that is a very aggressive TP. Now I'd say if you don't have much experience trading, you also don't want to be having a lot of aggressive TPs. Most of your trades are probably just going to be conservative TPs within the range. Inducement, flips, and origins. And again, all a flip is literally just a POI within a range that is not the origin. So if it's a POI that's not the extreme or the origin, it's a flip. So like, you can consider this a flip, you can consider this a flip. This is most definitely a flip right here. Whereas the origin, it will be somewhere around here. So I mean, it could be this, could be this. This is in the rough vicinity, right? This would be a 5-minute origin right here, right? If you go to 5-minute, this is the origin on the 5-minute right there. And of course, if you want to refine the POIs, feel free to, but you can see if you don't always want to, like, price is not always going to go to the exact refinement you refine it to, right? In this case, we hit the 5-minute, but we didn't hit the exact last 1 minute. We hit this 1 minute within the 5 minutes. So just something to be careful of. You obviously don't want to have very unrealistic TPs. As long as your TP is your drawn liquidity, and your drawn liquidity is likely to be correct based on your experience or screen time and what you're seeing based on structure. In this case, we were obviously bullish. We had a break structure here after we swept inducement. Had a break structure here. This is our new range from this low to this high. We came back to the origin here, took out this inducement. We actually swept in internal liquidity here. We had entry model, and then I just continued the external trend or internal swing structure in this case here, because the external structure is, you say, from this low or this high to this low. But you can see how we had a huge impulsive move. And what I tell you guys about huge impulsive moves, we tend to, for price tends to create new internal swing structure, and that's the swing structure we want to be trading the trend off of until it meets its objective of price, which in this case was at least this 5-minute POI. It could have for sure gone higher, 100% could have gone higher, but this is the most realistic area where price can mitigate. So hopefully that makes sense here. Basically just going again, very aggressive, conservative, and very conservative TPs right there. Of course, if you see my other trades, you will see other trade examples of this, and you'll see exactly what I mean by very aggressive. Here's another example of actually if you guys want to see more chart examples, here is an example of a conservative TP with my main setup. All I did was TP this long. All I did was TP at the flip. That's conservative. And what I TP here, I also TP'd. In this case, technically, you could say, this is the origin here. But in this case, this would be also conservative TP here. Now, if you TP'd, let's see if we find the origin. The origin is all the way up here. You can categorize the origin if you want, as aggressive. It's just I just had it in 4 categories because I don't want to make it too many categories. I don't want to make a very conservative, then like middle aggressive, then aggressive, right? So you guys get the point. Obviously, a flip is going to be a more conservative TP than an origin, but that's basically the vicinity or area of that I'm talking about. We're just roughly categorizing these targets. So then this here would be, again, an example of conservative TP. Instead of, I'm not targeting external structure or external swing highs and lows. I'm just targeting what's within the range, which is flips or origins. This here is also a conservative trade. Well, actually, okay, this is a little bit complicated just because we are making internal structure here in terms of this high here. And we also have something right here, a PY right here. So if I was targeting anything past this high here, you could technically call this aggressive. So this is a little of a funky situation. You can consider this as aggressive or conservative. It doesn't matter too much exactly what you're trying to say, as long as you're understanding that you have conservative or aggressive expectations for price. Here's an example of, okay, here's a perfect example. So let's say we're shorting here, right? On this IFEG, we mitigated obviously 50% of the previous range already, and we mitigate this flip. Just name it flip. This low here is considered a very conservative TP. This is basically the IFEG scalping setup right here. Now, if you were targeting, let's draw the 50% tool here real quick of this range. So you can see how the very conservative TP is basically never going to be respecting the 50%. It's not going to come back to the 50%, right? It's being that nearest internal high or low. You could also see this as internal high or low, up to you. But this stats in the most. Now, if you TP'd here, this would be your flip. Thus, this is conservative. So very conservative, conservative. You can also say this is conservative, just a little bit more aggressive. Aggressive is already down here at the external, right? At the external right here. So hopefully that makes sense. And then this trade here, I can give you guys another example as well. This here, if I took this is a stop under setup. If you don't recognize this already, internal sweep, and we enter off the candle closure. It doesn't matter how the candle closes to me. I just enter immediately off of it. And a conservative TP in this case would be, or a very conservative, if you're scalping, would be right here, this internal high right here. So that would be about 2 risk reward, not bad. If you were targeting conservative, it would just be this. I don't really see any other PY here, so within the range. So this would be your origin, this would be your conservative TP for 3.4. Aggressive would be the external, or in this case, obviously this is internal range structure, or external internal, what am I saying? Internal swing structure, that's what I'm trying to say, or external swing structure. Or, dude, I'm getting confused with the terms. Basically, you guys get the point, right? You guys get what I'm trying to say. So this is like new structure internally between this external structure. That's what I'm trying to say. Okay, so this would be your aggressive, and then what is very aggressive? Something like this, past that swing point. So either the POC, if you guys want to see the POC clear, here it is. I'll turn off everything right here. I don't know if you guys can see my cursor. You should be able to. I have it in OBS enabled, but for some reason, I guess it doesn't show, which is kind of odd. Let me see if I can see it. Yeah, I don't know. That's low-key weird. I don't think it's showing because I don't see it on my end. Oh, okay. So we'll probably just have to deal with that. I'm not gonna lie. Yeah, I don't think it wants to show. Oh, that's cool. That's cool. I'm just making sure my camera is also the right size here. Probably make it a bit smaller so you guys can see better. Okay, but basically You guys can basically see the POC right there, right? So that could be a potential very aggressive target. Or you find just like a POI right above. This POI right here, you have a POI right here. This is all imbalances, so you could pick any of these as your target, right? So hopefully that makes sense there in terms of examples of targets for your trades. Now that we've gone over the different types of TPs, basically adding on to 2 from the last list, which is just conservative versus aggressive. Now we have very conservative for scalping and very aggressive when you have a very high quality draw on liquidity. And of course that comes with more screen time and experience. Let's see what else is on the list today. So now I'm gonna talk about manipulation, futures versus forex. So for those that don't understand, the futures market is centralized. What does that mean? That means that all the markets or the chart that you're looking at is the exact same price, exact same high, exact same low as everyone else that's trading futures. Everything is centralized in one. You can think of it as like a database almost. It's centralized in one location. All your trades are going through the same processor, if you want to think of it like that. The same processing system. Therefore, the chart will look exactly the same. Like for example, here, I'll show you guys an example. Go to futures here. Whenever someone's on futures or trading futures, your Euro FX futures chart is going to be the exact same as mine. Now, there's different contract expirations, of course, so that's something you want to keep in mind. But if you're just using the continuous contract, which I recommend you always just select the 60. Don't worry too much about these letters. You don't need to memorize them at all. It just represents the different expiration dates in terms of months. But basically, if you use continuous contract here, which just means it just updates by itself to the best possible price feed or the most active price feed with the most volatility for that month, you're looking at the exact same price. It's the exact same chart. So like this low and this low are equal lows, and these lows are also equal lows when you're trading futures. Everything is centralized in one place, which is very good. That's a very good thing because you don't need to worry about broker manipulation. Now, here's the thing. When you're trading Forex, for those that are trading Forex, if you guys don't know, by the way, I used to trade, when I started trading, I started with like stocks and options. And then I did a tiny bit of crypto where I was doing leveraged crypto, but that didn't last very long. And then I basically later transitioned into Forex, and then I found futures, which is where I'm at today. And so I've experienced basically every single type of market, and I'm just telling you guys that in my opinion, you should stick with futures. It just has the best potential setup in terms of the system that it uses, right? Everything's centralized. You don't have to worry about broker manipulation. Now, what is wrong with Forex? Here's one thing wrong with Forex, in my opinion. It's just broker manipulation, like I said. Your chart in Forex it's decentralized. And what that means for Forex traders is that when you're someone that's looking at Euro USD, look, when you look up Euro USD on TradingView, for example, you can see on the right, there's so many different brokers here. You have CMC Markets, you have FXCM, you have Oanda, you have Forex.com, Capital.com, Pepperstone, IC Markets. These are very common brokers. That's why TradingView has them on the top of the list. But the point is, all these brokers will have not the exact same price in chart. So for example, if you go on, let's see, show example here. And the problem with them not having the exact same chart is things like this. So if I could remove this to the side. Like look at this. For example, here, do you see this? This tiny little wick by one tick, literally one tick basically, took out this low here. Now let's go to the futures chart. So go back to the futures chart. I remember this exactly because I was literally trading this. Or I was trading when this happened. Look, it never took out the low on the futures chart. And the one reason is obviously because the incremental, how the increments work on futures in general, it tends to be able to easily make equal highs or lows all the time, but it doesn't mean price took it out. That's why I tell you guys, don't have your stop loss right exactly at the low. Give it some space. Give it at least one tick or more of space, so you don't get stopped out, because this is not a valid stop loss or a loss. This is not a valid stop loss placement. It's down here. Give it some space. And so you can see how price never went below this low on futures, but it did go below that low on the Forex chart, which is called manipulation. Now look at this. Same thing occurred here. You guys remember that long that I showed you guys that I took? Well, guess what? I didn't get stopped out on futures. Why? Because look, we never took out the low. We just made equal lows. My stop loss would have been right here on the futures, right here. And if you're on Forex, it would have got taken out. We can hide everything. You can see the low here really took out the low by more than just one tick, basically, or more than one unit of price. And same with this low here. It got barely swept, but it did get taken out. So you can see this is just an example, and you guys can look back in your charts if you like. Honestly, if you don't trade Forex, it does not really matter to me. It's to you. It's just something to keep in mind when you're deciding if you want to trade futures or Forex. Basically, broker manipulation occurs. So that's definitely something you want to be careful of. Even if you trade like a very regulated broker for Forex or a very reputable broker, does not mean that the pricing is going to be very good. Like, for example, this low got taken out Forex right here. Let's check out the other charts. But they will basically take them out not by the exact same amount. So like, look at this. This is Forex.com, right? You guys can see the broker, Forex.com. Look at this. On Forex.com, EURUSD made equal lows and it never took out, actually swept a low here. But if you remember, if we go back to FXCM or CMC markets, we took out the low. So y'all see the price difference here? Discrepancy in price, even one slight difference can make or break your trades. It can either make you have a winning trade or a losing trade. Like this would have been a great winner here. This would have been a great winner. We're targeting to the left, you look to the left, to the 5 minutes, it's a great winner. But because of broker manipulation and differences between brokers on Forex, since everything is not centralized, it's decentralized, basically the broker has a say on how it wants to price certain moves. Obviously, they still move in correlation, like 100% correlation, right? It's not like Euros USD on FXCM moves different than Euro USD on any other broker. They all move the same. It's just these small little discrepancies in price will make or break your trades. Let's see if we can find more examples real quick. Especially if you get to like less and less well-known brokers, you're more prone to further manipulation. Because why do brokers do this? Well, because they know people that are at least making a ton of money trading on the 1 minute, like us, especially system I teach, it makes hella money trading the 1 minute. You can make a lot of returns with it, unlike the swing trading where you're on a higher time frame and you have a very low trade frequency. You will obviously get less manipulation on the higher time frames than in lower time frames. But you can see, I mean, something like this, right? Equal lows, took it out on the other broker. In this case, we also made equal lows here. But point is, we still took out this low here on basically every single Forex chart. And the futures chart, we did not take out that low. So there's certain things to honestly be aware of if you just do decide to trade Forex for some reason. Or maybe you can't trade futures. Just be aware. Or if you're trading like prop firms or Forex prop firms, right? We have different type of prop firms where Forex are valid, of course. And I've gotten payouts from them as well. Just something you want to keep in mind. If you were to trade a Forex prop firm, what is my suggestion? It's just to widen your stop loss. There's not much you can really do. You just have to widen your stop loss, right? Just give it a lot more breathing room. And there's only so much you could do, right? to widen your stop loss. So that would be my suggestion. Now, if you're on futures, and you guys know, even if you're trading futures where it's centralized, we will get internal liquidity sweeps. Like this here is indeed an internal liquidity sweeps. Right here, internal liquidity sweep right here. Right, we had an entry model here. You had IFEG or you had an OB entry model. It just failed, and then look, we turned internal liquidity sweep, taking out these early buyers. And then we had a valid entry model here on the OB, and we got a winner for our basic continuation model. And so if you want to just avoid getting really, if you like stopped out early and you don't want to be taking these re-entries, meaning 2 losses, potentially if you're wrong on the entire trade idea, then my suggestion to you, of course, always already in the first case, always have that +1 tick stop loss increase at least, or more. But of course, if you want to avoid these internal liquidity sweeps that occur, you would have to widen your stop loss even further. So maybe like 2 to 3, 3 to 4, however many ticks looks just about right. There's no 100% mechanical definition. You can make a mechanical definition if you want, by the way. That's completely up to you. I just traded with the +1 tick, and if I get stopped out, I will re-enter if the trade idea is still valid, if I still get confirmation. But again, for those that are not a fan of that, you'd rather do a little less work, not have to have these psychological issues of taking losses like that. Just widen your stop loss, man. Even if it costs you risk reward, it's helping your psychology. So just widen your stop loss so it covers a bit more space between that extreme high or low made. So that's my number 1 suggestion for those that are wondering how to avoid those. There's no way of 100% foolproof avoiding them unless you widen your stop loss like that, and just, you know, take the basically con of reducing risk reward slightly. So that's it really for that. There's another thing I was going to talk about, which is one more thing. I didn't want to make an entire video off this, so I'm just going to put into this video. But basically, limit orders. Again, when I tell you guys, if you have very clear continuation that has like a small enough range, of course, you have to make a mechanical definition for that if you want, or just look with your eyes. But if we have a very clear trending range, we have like clear drawn liquidities, like we have a clear drawn liquidity of this huge imbalance here, at least to mitigate the origin or something up here to the left, and we have new internal swing structure here, then we're obviously, my drawn liquidity is extremely clear in this case to the upside. If that's the case, I'm completely fine with, like I said, I already talked about this before, but you guys setting limit orders at the POIs. And this is the one benefit of limit orders. I don't know if I mentioned this before, but this is the one benefit of limit orders, and that is when you just set a pure limit order at the POI you're looking at, you don't have to really ever worry about internal manipulation like this or getting stopped out early, because you're typically with your stop loss, depending on whether you want to cover the OB, the POI obviously, or if you want to cover structure. I'd recommend covering structure for the most part, unless structure is extremely far like this. Maybe you want to cover just a few ticks below or above the POI like that. That would have been fine. You would have made a better risk reward in this case actually, but it's not always the case, right? But of course, remember, limit orders do come with lower win rates, so just keep that in mind because you're not waiting for any confirmation from the market. But if your narrative is right, you don't really have to worry too much about that, in my opinion. You can anticipate the market giving the entry model. So that's number 1. So number 1 is pro of limit orders is you avoid internal sweeps and manipulation like this. Number 2 is it's more passive trading. You don't have to wait, and you don't have to be as patient, and you won't miss any trades. So that's the number 2 pro of limit orders. You won't miss trades. Number 3 is, of course, you don't have to set an alert at the POI and then manually execute. You can literally set this limit order ahead of time right here. And whenever it executes, let's say you are going to go to sleep and you still want to take this trade, you can just set a limit order here. Make sure, of course, you need to pair that limit order with a stop loss. If you don't have a stop loss in place and you just have a limit order here, if the market just wants to tank, you're going to wake up to a blown account, okay? So make sure always pair it with the stop loss already predetermined or predefined. If you're going to trade off limit orders, that's a must. Actually, that's literally how it is for even taking market execution. You should almost always immediately set that stop loss, basically, as soon as your market execute. One more benefit. So far I've talked about internal manipulation, benefit number 1. Benefit number 2, it's more passive trading, so you save more of your free time. Number 3 is what was it talking about? It was I forgot what number 3 was. I think I mentioned something else, but basically the last pro is that you are essentially able to move your stop loss and tighten it if you're wrong. So for example, let's say you had a limit order here and you see this reaction in price and you see an entry model presents itself already. You could then move your stop loss immediately below that lower high made after you see the entry model given as confirmation. It'd be the same as you taking the Aussie entry here, except your loss is going to be much smaller. It can be a lot smaller sometimes. Sometimes it might not be as much smaller. It really just varies a lot. But when you do that, of course, you have to consider if we do get that internal sweep, you will miss the trade doing that. So just keep that in mind. But majority of times or not, it will save you moving that stop loss to that new basically internal swing made once the price gives you that reaction off your limit order. So that can definitely save you from taking a lot of full losses. You probably take half losses from my back testing. You probably take half losses moving your stop loss like that with limit order reactions. So again, hopefully that makes sense to you guys. Basically just going over, what did we go over today? We basically went over aggressive, conservative TPs, the 4 different types of forms. We've gone over Forex versus futures and why I recommend futures. It's centralized versus Forex is decentralized. You can get manipulated a lot more often. You'd have to increase your stop loss on Forex when you're trading compared to futures where you can just have that plus one more tick of stop loss space. And then we, of course, we went over a few benefits and pros of limit orders. And then the last thing on the agenda today is basically just going over these trades, guys, these trades. And in fact, let's see. Okay, yeah, we'll go over these trades real quick to end the video, and we'll go over them very quick since you guys already get the gist of most of them. You guys already saw most of them. Oh right, I charted them on EURUSD. What am I saying? Okay. So trade recap time. This is of course Asia session, right? Here we took out the low on the futures chart here. So we had a SMT, basically SMT, all it means is really just a correlation or divergence, whatever you want to call it. Basically the futures chart, we took out this low already. And therefore that means we already completed the QM model here. Because we already completed the QM model, we can expect a reversal in price after taking out that target. So I waited here. We had a OB entry model here, very straightforward, 3 risk reward. I did not have a aggressive TP here. I was originally thinking about this being my TP, but then I realized looking at structure here, we had a very strong flip here. And why is it very strong? Because we had new value created here that created like basically new structure here, internal swing structure here. And therefore, this flip here is aligned perfectly with the supply and demand, that new internal swing structure. So you can see how this used to be demand here, and this here basically flipped it into supply. So when we have things like this align, basically if you want to think of it, think of it like a break and retest. If you don't know this, just Google it. It's a pretty basic retail term, but if that doesn't make sense to you, just Google that. So because of this, I was realizing these hold a lot stronger for flips. When it does flip structure, that's very important, like this. So this is literally basically swing structure here, just internally. So I just TP there, and then what would happen here? You had two options. You can enter off the OB entry model, which you would have gotten here for 4 risk reward, or you enter off impulse model. Why do we use impulse model here? Look at this delivery here. We had impulsive candles with imbalance. Almost every single candle in this entire leg is a green candle, right? again, A plus impulse model delivery would be if the whole entire leg is basically impulsive like this. If only part of the leg that gets near price is impulsive, it's a much lower probability of trading an impulse model. For your looking back, of course, I could have made a lot more if I just held and just targeted the low again. Of course, I missed out on a ton of money here, but it's just the name of the game, man. And the reason why was because we took out this low. I was thinking we could actually continue higher, and I don't want to miss this move if we do continue higher, because taking out like a QM model, so we have the QM model, taking out this low, what am I doing? Where's my drawing? Is considered, this low is most definitely considered going to be like a higher time frame low, because a lot of time has gone by, right? How much time is this? Five hours of price action has gone by. So this is most definitely like at least a 1 hour low. You can see this is indeed a 1 hour low here, right? And obviously we SMT'd with that. So I was very careful with that. And therefore, we know that when we take out a high time frame liquidity, we tend to get a bigger move. So I just had a conservative TP here for forward sword, and I took an OB entry model after mitigating the origin here, and I just took a loss. I didn't place my stop loss at here with this big wick. I just don't like that risk. The risk reward is just bad, so I'd rather take the risk of potentially getting stopped out a bit earlier with a tighter stop loss. So I lost one there, so about 6 risk reward here made. If you miss this short here, don't FOMO. You can see we won't always do this, but we do come back later to mitigate it again, or mitigate this OB that was unmitigated here. And you could have caught a really nice 5 risk reward. So if my draw liquidity was better here, then I would have made a lot more. I would have been able to bag that 4 risk reward, and then price came back. Could have had another limit order to make more, but you can see draw liquidity is very important, guys, and you won't always get it right. I don't always get my draw liquidity right. You just want to be more often times right than wrong. That's basically the gist. You're not always going to be right. So there's that. And then these trades here, I'm going to use this here as a quick example for another video. But essentially, here's an IFVG scalp setup, right? Body closure. The proper entry would have been actually here with this body closure here, but whatever. And then stop loss here, you would have it right above here, and then TP at the internal low right here, right there. And then basically took a stop hunter setup here for forward sword. And I just targeted the berry structure here. I believe I'll have to check later if I changed this or not. But I believe I targeted the forward sword there, or you could target POC, of course, for more reward. And this is very basic. This is literally a mitigation phase here. We had a full entire real structure here. We came back to at least 50%. We did indeed mitigate this PY right at 50%. You guys know I'm not a big fan of mitigations exactly at 50%, right? So just not a huge fan. So this setup here was not my main strategy setup. This was literally just a stop hunter setup. It just perfectly aligned in terms of the 50% level. So took it here, stop loss. I placed it basically right here, around somewhere around here, because I'm basically covering this PY right here, basically. Or I'm basically expecting price to not mitigate this PY below, but we can mitigate this, right? And we basically already did mitigate at that point when I entered the trade. So prior to mitigation, stop loss placed right there, and hit for reward. Now next trade, we went to the POC eventually. We manipulated actually after reacting off the POC. Unfortunately, it is what it is. Took this loss here. I did not unfortunately have a limit order for this trade, even though it was an A+ setup. I should have used that instead, but internal swept. I basically entered off this OB here. Let me delete that. Basically entered off this OB here, and then I did not go break even here because this is typically what happens. Is my rule is if I go break even, or if I take an A+ setup, I don't go break even. I just let the trade run. If it's a B+ setup, I may or may not break even. It just depends on the context, right? In this case, I basically took just long here. And of course, you guys know I take my entries obviously on the futures chart. So I didn't get manipulated here. I was fine. And basically made about 3 to 4 reward here. And this entry was just off IFEG. Again, I like IFEGs if it gives me a good risk reward because I get to not miss the move. Plus, this IFEG is very close. And when it's very close to price like this, and it inverses with momentum, it's a very good setup. Now, if this IFEG was like all the way up here, then of course not. I would definitely not be taking something like that. So just look at your pros and cons whenever you're trading, your upside and downside. And then, of course, one thing I do want to cover real quick, just as an example, if you miss this initial entry here, don't FOMO, right? You will almost always, you won't always get an opportunity to enter a move again if you miss the initial entry, right? It's not guaranteed. But if you do wait patiently for your setup to come to you, you will be rewarded. So here, we had a stop hunter setup here. We mitigated a PY that you're expecting to fail. We had a closure right here, right? We took out this internal low. We enter immediately off market order. Stop loss placed. I probably would have placed it right below this low here. And then TP, you can TP at, of course, conservative. I'm going to show you guys examples here. Conservative, aggressive, very aggressive. And of course, in this case, this is a high probability, very aggressive TP because we're expecting this high to be weak. So there you would have made full reward, a bit more than me if you were taking the stop under setup. Otherwise, if you missed that, then there weren't many other opportunities you could have really entered. You had an IFEG here, or even an OB right down below that you could have entered long. And let's see if there's any more examples of potential entries. I mean, we did mitigate this PY here. Some people like to take internal continuations like this. Personally, I rarely ever take trades like this, but I know a member in the group that does take trades like this and he's profitable. So, if you want to take these type of internal continuations and you backtested it, feel free to, right? All it is literally just setting limit order at like a, basically an OB while price is drawing towards your drawn liquidity. So price still hasn't reached your drawn liquidity or TP. You just set a limit order at the nearest basic OB and cover it, give it some space and then just TP, right? Some people do that. I know a member in the group, again, like I said, that does do that, and he is funded right now. So that's that. Just make sure you backtest though, because I told him to show me his backtest results and they were profitable. So just make sure that you backtest, and as long as it works, trade it. I don't care. It really doesn't matter to me as long as you have an edge. And of course here we mitigated, we tapped into a POC right here, right? And we just shot up. And again, manipulation legs in the market. We mitigate this PY here, manipulation. You should not be shorting this. Even if you see something like this, you should not be shorting this because you have a weak high right above you. So again, context is important when it comes to trading. Ultimately came up to the 5 minute right there. You can see the 5 minute right there, mitigated. And this sucks, man. I was looking for this short here because I was looking to long this internal swing structure to the 5 minute supply to then short. But the 5 minute is dumped. It just completely dumped on me. The only entry you could see on the 1 minute is this IFEG. And if you had a tight stop loss, it would have been something like this. That's still a good risk reward, 3 risk reward. It's just, I just missed it. I was waiting for an OB retracement and it just never happened, man. But if you were on the 30 seconds, you would have had a OB retracement there on the 30 seconds actually. Yeah, how much risk reward would this have been? 4.5. So that's a good amount of risk reward to make for sure. And then this was my last trade of the day. And it was very simple. We have an impulse price delivery, right? Huge imbalance right here. Here we did not have much imbalance, so this is what I would call a lower probability impulse model. But seeing how big and massive these candles are when as is delivering to my POI, and this was a potential area of price. This is, what is this? Go to the 5 minute, or sorry, not the, what am I doing? It does 15 minute. If you go to basically higher time frame, this all basically looks like inducement. You can even see this all as inducement, like even on the 1 minute here, right? Now, of course, this is not inducement here if we are gonna continue higher in terms of if we didn't have this move here. If we just mitigated this, like if price did not break through this PY here, price did not break through this PY here and held it, this is then inducement. So this here is inducement for this PY here. But since you can obviously see price completely disrespected this PY, this is now inducement for this PY right below. Because this here, based on my rule, it did come back to mitigate to 50%. However, this is lower probability structure. Why? Because it didn't actually mitigate like a PY. You had a PY right sitting at 50%, which is, again, not my favorite right here. But I was really hoping for price. Now, okay, I was in a long here, so I was obviously not hoping for price to come back here. But what I mean by that is if price did come back here to mitigate this and then create that base structure, I wouldn't view this as much as inducement. It created its full entire pullback or structure. But anyway, nonetheless, you can see the reaction obviously failed at the PY. This would just be inducement here. Now, this does not mean we continue going higher for this high. That's why I just had a very small TP here. I only made a mere 2 risk reward, which is not much for impulse model, because typically impulse model will give you the best risk reward, either that or OB entry model. But I just TP'd at the flip right here. That's it. And then of course you have the origin sitting above. If I trailed my stop loss, sure I could have made more, but it is what it is. And you can see we impulsively delivered towards the PY and towards my TP. Hence, never coming back towards the OB. Can I have anticipated that we could continue the bullish trend instead? It's a good question. Potentially, but knowing that I took an impulse model, I was already at break even here. So for me, basically right here, I already moved my stop loss to break even here, just because knowing that this is impulse delivery, price should not be coming back for the most part. Sometimes it does and it still hits TP, but for the most part, price shouldn't really be coming back to mitigate the OB. So I didn't want to risk that unrealized profit. I was just like, screw it, I'll just close out for 2 risk reward and end the session green. If you were asking me the reason as to why we continued higher even after mitigating, one thing you could look at and notice is we have this on the 5 minute that got mitigated, and something I actually drew up that got deleted. I just realized. I'll have to check later in a bit. But we have previous day low here. This is high time frame liquidity, right? Remember, very high time frame liquidity. We can expect huge moves off of sweeping that liquidity. So you can expect obviously a very big move after sweeping high time frame liquidity. I think it was a 4 hour. Let's see. It was a 4 hour. So I had this drawn. I just deleted it. This right here. You could find it. Obviously, this is a massive POI actually. But refine it to this sell to buy, it would have been like this, like wick to wick, low key. Sometimes I do something like this, just because if it's too big, I just refine it like that on the higher time frame roughly. All that matters is price hits basically the start of the POI. So right here, we hit the 4 hour domain here. So based off this, you can then understand this move, why we continued higher even after hitting this 5-minute supply, right? It all makes sense now. It's like a picture. Took out high time frame liquidity, tapped into 4-hour demand, which is higher time frame as well. And if you overall just go to the higher time frame, if you look at structure here, we are maintaining these lows here, right? And we had a very nice closure above on the 4-hour, which is a huge deal, right? And basically the 4-hour is doing something like this. And all it is coming back for a mitigation phase. So putting that together factorly on the lower time frame, you can then expect, of course, supply to stop holding. Now that doesn't mean, of course, we run these highs immediately without this reaction here. This supply holding here does not mean we would just continue going lower, right? It's just it could just be a mitigation phase. So just keep that in mind. One more thing I want to bring up before I end the video. I know it's a very long video and I'm low-key tired. This is a really good example of an impulse candle delivery right here. You guys see? Let me just turn that off. Look at this impulse here. It's like 90% bearish candles in one direction, and they basically almost all have imbalances, tons of imbalances. So if you wanted to, for a valid main setup off the 4-hour, you literally would have just caught. You guys see the impulse model here? Yeah, you do see it. I know you see it right here. You would have just caught this and taking my normal setup. You would just made basically 7.5 risk reward, right? Just TPing to the basic 5-minute origin. But this is obviously a way for me to show I missed the trade. I missed the initial setup here. I missed it, and it is what it is, right? So I found a way to re-enter here off this stop under setup here. So that's where that came from. But yeah, that's basically it for this trade recap. I don't think I'm missing anything else. If you guys have any questions, let me know. And I'll see y'all in the next one. Peace.